Assalamu alaikum and a very good Assalamu alaikum and a very good morning, everyone, and a very warm welcome for today's session. I'm Khushbu Mushtaq, the Director of Advisory at athGADLANG. For those joining us for the first time, athGADLANG is a management consulting and an accounting firm supporting businesses across advisory, governance, and compliances. As our motto, or maybe as our vision, we have been conducting various webinars regularly to share practical knowledge and insights on various topics such as UAE corporate tax, IFRS, ESG, some speaking skills, some job hunting, visa issues, whatsoever. Based on the current topics, we do share our practical insights with all of you. But today, we turn our attention to another critical area of corporate governance, which is financial crime compliance. So financial crime continues to evolve, and so do the regulators and the regulations as well. The UAE has recently introduced significant updates to its AML and CFT framework. These changes strengthen the country's compliance environment. It expands the enforcement powers and bring it closer alignment with international FATF standards. But that raises an important question for every organization. Are the controls that worked yesterday, are they still enough today? Here where your consultants or your compliance officer will act. Because see, compliance can no longer be treated as a policy sitting in a folder and you're giving a checkbox and it's being checked once a year. It is no longer applicable. It needs properly understand. It needs to be properly implemented. It needs to be properly reflected in the organization's day-to-day operations. That's why we have brought our experts today. They will be guiding you how you're going to implement all these in your organization. What are the changes? What are the practical implementations? What are the fines and penalties that you must be aware of? What are the changes that you need to build it in your hierarchy, in your people, how you're going to train them, everything that you need to know as an organization to implement the latest laws, regulations pertaining to financial crime. Today, our experts will be sharing that with you. So again, thank you for joining us. I hope today's session will be very valuable and practical for all of you. With that, let's begin. I would like to introduce all my speakers as well as myself. So I'm Khushbu Mushtaq. Again, I am the Director of Advisory at athGADLANG and I'll be your host for the event today. I have with me three strong speakers from AML and CFT background. Mr. Saqib Nisar. Mr. Saqib Nisar is the managing partner at athGADLANG. He brings over 30 plus years of experience in global consulting. Over the years, he has led fraud investigation and dispute services across Qatar, Kuwait, and Oman. He's very well known as an innate investigator, someone who can take complex financial data, turn into clear, actionable insights. That's exactly the kind of expertise financial crime compliance in this region calls for. The next expert that we have is Ms. Sehrish Bhatti. She's the assistant manager at athGADLANG, and her work sits right at the heart of today's topic. She has led many AML and CFT compliance engagements in the UAE real estate and financial sectors. She has also conducted entity-wise risk assessment, and she will be a very valuable speaker for today's event. I have with me today Mr. Nasser Mahmood, an expert on CFT and AML, and he currently serves as an expert at Central Bank of Oman. He has advised on national AML and CFT strategy for banks, fintechs, and virtual asset service providers. So join me in welcoming our speakers, and hopefully today's session will be very good, and I'm sure everyone will enjoy that. So maybe we can start with Mr. Saqib Nisar. Saqib, would you please take us through the enforcement impacts of the recent developments in AML and CFT framework. That will definitely help our valuable attendees today. Sakib, you are mute.
Thank you, Khushbu, for the introduction. Good afternoon, everyone. I think what we'll do is we will be taking you through multiple developments within the AML CFT sector in UAE. And during this session, if you have any questions, please feel free to ask those questions through the chat, and then we'll be able to answer those questions at a later stage. Perhaps before we start talking about the AML CFT regulations, what I would like to highlight is, what has changed. I mean, for those of you who are in the compliance function, you must have heard quite a lot of noise, news, articles on how the regulators are effectively monitoring, penalizing companies, banks, financial institutions for non-compliance. So prior to that, I think if we had talked to you about the violations, I'll take a couple of steps back and take you what happened with UAE. I mean, we were on the grey list back in 2022. And the reason given by FATF at that time was there are strategic deficiencies, primarily relating to weak financial regulations and enforcement. And the third area which they were concerned about was the real estate sector, right? So that report was issued, we were on the grey list. Then the regulators in UAE started working on those kind of deficiencies, and there were multiple inspected. And in early 2024, there was a follow-up inspection, and as a result of that, we were no longer on the grey list. So UAE is no longer building an AML framework. We have already built it. It is now in the enforcement era, right? And that is evident from the inspections that various regulators have conducted in the recent past. And you see 1,000 plus AML violations identified by Ministry of Economy only in 2025. And in terms of enforcement cases, this is primarily what FATF wanted to see, that they wanted to see how the regulators are implementing their regulations. And again, a recent famous case that you may have already seen on Khalij Times, where a foreign bank branch on 24th of June 2026 was fined around 20 million dirhams. But what is more important here and concerning for the compliance fraternity is the personal penalty. So this individual head of compliance was fined 300,000. It was a personal fine. And we've not seen that in the past. We've seen more on the companies being penalized and companies paying those penalties. But now it has come to personal liability, which is again an eye opener for the compliance fraternity to make sure that they are covered, because personal liability is significant for an individual. Next slide, please. So in terms of the regulators, we've seen that it's not just Central Bank of UAE. You've got Ministry of Economy, you've got DLD. They're all part of the kind of regulatory umbrella where they cover different entities who are involved in different businesses. But what has happened in the recent past, and then Nasser will cover that at a later stage in terms of what regulations have been put in place. What I wanted to highlight is specifically this maximum corporate fine double to 100 million, right? And that again is a huge number in terms of penalties, which is prior to that it was around 50 million. Now they can also penalize you in excess of the criminal property. So let's say if the money laundering or the amount was 100, they can penalize you 200, 300. It doesn't mean that they stop at 100. Financial crime fines, 5 million, new penalty bed up to 10 million for reporting breaches or tipping off. Again, this is something new. In the past, if there was a money laundering, they would fine you. But now, let's say if you're reporting breaches or tipping off a customer, you could be fined 10 million. Again, that's significant. The other area which they can have strengthened is dissolution and closure powers. And again, if you go to Khalij time, some of the news, you would have seen exchange companies closed because of money laundering violations. And the regulator is is very practical. It's not as if they would come in and ask you to close the business immediately if there are violations. These are multiple. You've been given various warnings and you've not implemented it. As a result of that, you've seen exchange companies being closed. Personal liability, I've already talked about. Again, that's a major concern, because that is not just a financial penalty, but that also has an impact on your compliance officers future, right? I mean, if you're penalized, just imagine if you were to go and look for a job elsewhere. I mean, your name is going to be all over the place. So I think all the more reason it is important that we embrace the new regulations. Next slide, please. So again, Nasir will talk about this Article 35 and offense is one which is maybe intentionally providing misleading beneficial information. Again, imprisonment, just imagine that. And again, intentional breaches of preventive measures. When we talk about preventive measures, we are again talking about, customer due diligence, KYC, if you're noting that properly, again, minimum 510,000, but again, imprisonment. So please bear that in mind. This new law, which was issued in late 2025, has put all sorts of penalties and repercussions for compliance officer and board of directors in particular. Next slide, please. Nasir, over to you. So we're going to be talking about FATF here. If you can just kindly take us through what changes are upcoming and how it has impacted UAE. Nasir, you're on mute.
And thanks, Akib. And I am truly honored to extend my, I think I'm audible.
Yes, you are audible, but I don't see on the camera. I think, yeah,
your
I can see
voice is echoing.
So I think if everyone can be on mute and then Nasir can talk.
Yes, thanks, Akib. And I'm truly honored to extend my gratitude to athGADLANG for the invitation to join this important dialogue. Exploring the evolving financial crime compliance landscape in UAE is not only timely, but indispensable. And being part of this important conversation is both a privilege and a responsibility. I greatly value the opportunity to contribute to today's exchange of ideas and comments athGADLANG vision in spotlighting such an important topic at such an important time. I will start with the brief introduction about Financial Action Task Force and how it relates to our today's topic, that is exploring the evolving financial crime compliance in UAE. Financial Action Task Force is intergovernmental body that sets the international standards to prevent money laundering, terrorism financing, and proliferation financing. It also monitors countries through mutual evaluation to assess both technical compliance and effectiveness of AML CFT system in the country. Now, how it is conducted? FATF mutual evaluation has two parts. One is technical assessment and the other one is effectiveness assessment. Technical assessment covers FATF 40 recommendation and assessors assess the countries through compliant, largely compliant, partially compliant, or non-compliant. When it comes to the effectiveness assessment, they have 11 immediate outcome and the assessors assesses the country through high level of effectiveness, substantial level of effectiveness, moderate level of effectiveness, or the low level of effectiveness. The way Saqib has said that UAE went into the grey list in 2022, what was the reason? How does the assessor decide that it goes to the grey list? Either the country has 8 or more non-compliant or partially compliant in technical compliance, or the country has 7 or more low level of effectiveness or moderate level of effectiveness in IOs. Already, Saqib has covered that UAE went into the grey list in 2022. However, after the successful completion of action points, the UAE was removed from the grey list in 2024. Now the question arises that why we are talking about FATF. What is the importance now? The importance is that fifth round of mutual evaluation for the UAE is under process, and UAE mutual evaluation report will be discussed in the plenary session of February 2027. Now you can understand the issuance of the new laws, multiple regulations, numbers of regulations by the multiple regulators, reinforced by the imposition of penalties and the fines widely reported in the media, as already covered by Saqib. So it is actually the preparation of the fifth round of mutual evaluation. And please understand that non-compliance is no longer a choice. It's a costly risk. The sanctions introduced by the regulators are effective, proportionate, and dissuasive. These are the FATF terminologies. And we, being the regulator, has to show the evidence of this effectiveness. Now, it is no more that the fines are only imposed to the institutions. The fine imposed directly to the MLROs and compliance officers, conveying the message that accountability is now personal and the stakes are higher than ever. So just I have correlated that how the FATF matters. Please, the next slide. Now I will just briefly describe the laws and the regulations which has come up in last few months. First of all, and the foremost important is the Federal Degree Law number 10 of 2025, which has actually replaced the AML law of 2018. It has expanded the scope to virtual assets, non-profits, and importantly, proliferation financing. And it enhances the financial intelligence unit powers for transaction freezes. I'm just covering a brief because I would be more covering the regulator expectations on all these laws and regulations. Then the Cabinet Resolution number 134 of 2025, which provides the detailed executive regulations for compliance. Then Cabinet Decision number 111/2022, which is actually, this was very important because it establishes a regulatory framework for virtual asset service providers. After that, the VARA authority has been formed in UAE that mandates licensing, registration, and monitoring of virtual asset service providers. And now UAE is aligned with FATF guidance on crypto assets. Coming over to the guidance on proliferation financing risk, I am going to cover in detail in subsequent slides. But CBUE has updated multiple guidance to strengthen supervisory expectations for banks and the financial institutions. And DNFBPs, they have a comprehensive framework now for DNFBPs that includes supplemental guidance for real estate agents and brokers. Even it expands obligations for lawyers, accountants, and company service providers. Now coming over to the interesting thing for all of you, that what does regulator expects with this FATF mutual evaluation coming, with all these laws, with all these regulations coming up. Now, what is regulator expecting from the regulated entities? Now, the regulator expects that regulated entities must adequately apply AML CFT preventive measures and must report STR timely. This is a basic requirement of FATF assessors. After all these laws, after all these regulations, all regulated entities, I expect they must have revised their internal policies, procedures, and controls to fully reflect to the assessor team and to the regulators that the new AML CFT law and subsequent regulations have been properly implemented in their institutions. The way initially Khushbu has already highlighted that regulators no more want just tick the box approach. Now, the fifth mutual evaluation round of the FATF, they are more focusing on effectiveness. This is the major change from the fourth round. So if you have to show the effectiveness from your as a regulated entity, you must have identified the gaps and implement the control measures related to those gaps. And it is not only identifying and implementing. You have to document. You have to document all these controls, and you have to show the evidence to the inspectors that you are effective, you have identified the gaps, you have implemented the controls. Otherwise, we all know the failure to close these gaps would lead to the fines, criminal liability, and even license suspension, as we heard in the media. NRA was issued in 2024, so I expect and I understand that all of the regulated entities must have revised their enterprise-wise risk assessment. So I'm not covering in detail. What regulator, just a minor things for the policies and procedures, because whatever the auditors or the inspectors are pointing out, Sarish would be covering in detail, but just the minor things that I have observed being a regulator, and regulator are also being inspected by the FATF assessors, the World Bank team comes, the IMF comes. So the wording of the regulation and the wording of the policies, we should not use the weak language, the words like maybe or other such words. When you are going for the policies, when you are going for the regulations, the words must or should be is the actual terminology. Just a minor thing, because normally we don't cover. Then the policies, procedures must be approved by the competent authority. In regulated entity case, it should be normally board or the senior management. Now, the last thing that now regulators has to show the effectiveness to the FATF assessors that they are very effective in enforceable means. What does it mean? That regulated entities understand that sanctions would be applied for non-compliance. And what these sanctions could be, it is very evident by the publication of the fines and penalties to the multiple organizations. So I've just covered a brief that now what regulator is expecting, what are the observations normally they take. Sairej would be coming. So please, next slide. Now, I'm just going to cover the proliferation financing because it has been added in FATF guidance. Initially, we used to say AML, CFT. Now it is no more AML, CFT. It is AML, CFT, and CPF. What is proliferation financing? It is actually providing financial services for the transfer and export of nuclear, chemical, and biological weapon. Please understand only these three types of weapons: nuclear, chemical, and biological. It does not cover the conventional weapon. So when we are covering PF, we should not mix it up with the conventional weapons. It is only related to the weapon of mass destruction. Now, how does FATF defines it? FATF refers to it the risk of raising, moving, or making available funds or other assets or economic resources or financing in whole or in part to the persons or entities for the purpose of weapon of mass destruction proliferation, including, please remember, including the proliferation of their means of delivery like missiles and other things. So this is how the FATF refers. Now, what can be the PF threats for the regulated entities? For us, important are the financial products like trade financing, We have to be very careful while doing the trade financing that dual use goods are not involved. We are not trading to the high risk jurisdiction. We are not trading to the even the neighboring country of the high risk jurisdiction. Then revenue raising activities. It may include the use of front companies to raise revenue. Normally, if we go into the examples or the case studies, North Korea has raised multiple front companies to do the PF. And then it is even the cross-border smuggling of cash, use of crypto assets, and other things. And finally, financial and corporate structures. So we should be very careful about the shell companies and the front companies. Now, what are the resolutions? There are actually 3 resolutions that I've covered here. One is UNSCR 1540, which deals with the non-state actors. It is actually very difficult to identify non-state actors when it comes to PF. And that is why CBUE guideline on proliferation financing does not mandate the freezing of the finances in this particular case. Few of the jurisdictions has not even covered UNSCR 1540 in their guidelines, but CBUE is covered, so we should be careful about this. Then coming over to United Nations Security Council Resolution 1718 for North Korea. Sanctions against North Korea are very comprehensive. But fortunately, in UAE, we don't have the diplomatic relations with the North Korea. We don't have any presence here of their financial institutions. So things are comparatively easy, but we need to remember that DPRK is also included in the blacklist of FATF. So any citizen of the North Korea has to be dealt with very enhanced due diligence. Normally, the regulated entities' internal policies does not allow to have all those accounts, but those are the internal policies of the regulated entities. Iran, that is covered by UNSCR SCR 2231. Iran is the most difficult because one, it is our neighbor. Secondly, the sanctions on the Iran are always evolving, are always changing. So as a compliance officer, we need to be very much updated about the sanctions on Iran. It is not only the international sanctions, even the UN resolutions keeps on changing. So one should be updated about Iran. Again, Iran is in the blacklist of FATF, so we need to be careful. And although UAE entities are not bound by the sanction regime of other countries, but there may be potential secondary sanction implications for engaging in significant transactions violating OFAC US sanctions. So please be careful about this. Now, the final FATF recommendations, I will just cover briefly recommendation 7 that requires country to implement targeted financial sanctions relating to the prevention, suppression, and disruption of proliferation and its financing. So I've just covered just to make you understand. So if you have any queries or questions about PF, you can always ask. Next slide, please. The last slide, I have just included tax evasion as a separate slide because of its importance. We must understand that tax evasion is no longer a tax authority issue. It is now a predicate offense of money laundering. All the regulated entities must treat tax-related risk with the same seriousness as we are treating the other predicate offenses of money laundering, like fraud, like corruption, even like terrorism financing. And now the tax evasion is a criminal liability. So we need to be very cautious and careful. Now how? Because it has become a criminal liability just a few months back in UAE. So how as a regulated entity, we can suspect the transactions are related to the tax evasion? There are a few ways, like in UAE, We have adverse media covering multiple investigative journalism related to the tax evasion in UAE. Then we have the VAT registry. So multiple ways to understand and do the suspicion. But what we have to do as a regulated entity now, which was not there earlier, now once we have the suspicion, we have to immediately file our STR to FIU. So thanks a lot. I am hopeful that I have not taken a long time. Over to Sarish for an important topic, that how the audit observation of the regulators are.
Thank you, Nasir. Thank you, Khushbu, for the very nice introduction. And okay, so I'll quickly cover these topics here. The differences, the new sectors that have been included are non-profit organizations and virtual asset service providers in the recent amendments to the law. And the existing categories were financial institutions and DNFBPs. Within the DNFBP category, gaming operators have been introduced or have been covered in the law. Next slide, please. Again, one change related to governance is that now there has been two-tier national structure. Supreme Committee has been introduced and National Committee. Next slide, please. So this is the main topic, observations during inspections. Since we have different regulatory authorities, I'll be covering observations by them so that we can have an idea of the nature of observations and how the individual organizations can fix them. We can just think about it. So obviously, due to upcoming evaluation by FATF, there is the frequency of inspections, the frequency of regulatory inspections has significantly increased, right? So as a result, we have two choices. Either we can become the headline, or we can become the organizations, the entities that fix their compliances. So I'll quickly cover the inspections, observations by different different regulatory authorities, starting from ADGM. ADGM has covered DNFBP sectors, inadequate business risk assessment. So I'll be first covering the thematic reviews, and then I will be touching upon the enforcement actions taken by the relevant regulatory authorities. Inadequate business risk assessments, TFS not assessed as distinct component, and inadequate customer risk assessment. Enhanced customer due diligence is weak. Source of funds and wealth relied on customer declarations without independent corroboration. And senior management approval not obtained. Annual AML review is considered as a tick box exercise. CBUA, first, we can look at the thematic review for the insurance sector. 78% did not comprehensively document their business risk assessment. 88% of full scope firms had KYC and due diligence deficiencies. That beneficial ownership and over-reliance on intermediaries, beneficial ownership not identified adequately. 32% had policy failures. So this is not covered on the slides. I'm giving information based on publicly available information and inspection reports. And I will be, as I said, I will be covering thematic reviews, and then I will be talking about the enforcements. Okay, so 42% had deficient non-role tailored training, weak proliferation financing coverage. And since insurance specifically, there are two types, right? General insurance and life insurance. So for general insurance, the risk rating is medium, and for life, it can be high. And since proliferation financing has been introduced, so dual use and marine insurance sanctions controls were flagged. CBUA, again, thematic review of payment service providers. They are saying that it is better and controls are better as compared to the insurance, and the framework is maturing. Only 24% had a dedicated AML committee. Sanction screening, 65% comprehensive. Gaps in screening directors of corporate customers and agents. Now, this observation, there have been gaps identified in ADGM also in UBO screening. Then 12% still lacked automated transaction monitoring, weak typology-driven scenarios, and post-STR risk reclassification. Only 57% of customer risk rated, generally maturing compared to insurance sector. And banks, the thematic review is largely positive, and millions of records have been screened against local list and against UNSC list, and systems have been judged effective and freezing is prompt. As far as enforcement is concerned, the recurring basis cited is significant failures in the AML-CFT framework, failure to comply with AML-CFT policies and procedures. Notices are anonymized, so itemized deficiencies are not published. The new trend is going, as Nasir and Saqib already highlighted, it's going towards personal penalties that recently in 2026, June, 300,000 penalty has been imposed on MLRO and compliance officer. And in May last year, 2025, a penalty of 500,000 and a permanent ban was imposed on MLRO. As for DFSA, for the DIFC entities, the thematic review is 21% of MLROs at the firms fail to complete or fulfill their 15-hour CPD minimum requirement due to hybrid MLRO roles. And among DNFBPs, only 2 sample MLROs met the benchmark. This is mainly training deficiencies are there, and it's considered as a tick box exercise. And for enforcement within the DFSA sector, there has been a fine of 91,813 dirham imposed on DNFBP because of alleged wash trades. That is, the same owner, same beneficial owner is on both sides of the transaction. As a result of which, there was a 27% price hike. And so the brokerage entity on whom the fine was imposed was fined because they failed to report. So the brokerage entity that was fined was, the reason was they were not involved directly in money laundering. They were not involved in wash trades, but they failed to report STR on a timely basis. Then Virtual Asset Regulatory Authority. Since virtual asset service providers have been recently introduced in the AML ambit, AML landscape, so business risk assessment capability, the thematic review is that the business risk assessment capability across licensees is only developing. Weak data use, obviously the input is weak, so the output is also weak. Weak governance are the main recurring gaps. Firms under address AI, new technology, proliferation financing, and targeted financial sanctions. Need board approval and independent challenge of business risk assessment methodology. Must integrate travel rule data into sanction screening and assess counterparty VASP exposure to high-risk jurisdictions. Findings must feed transaction monitoring thresholds, EDD, and resourcing. And as for enforcement, VARA has basically named the entities it has imposed fines on, and cited licensed entities and cited the reason as AML failures in the AML program and internal systems and controls, and in August 2025 and June 2026. And 2 unlicensed entities have been also fined. They've also been named, and unlicensed. The reason is unlicensed activity plus onboarding users without meeting KYC obligations. Further, they have taken a bulk action against 19 firms in October 2025, and the reason is unlicensed activity and marketing rule breaches, and the fines range between 100,000 to 600,000. So where the regulators have named the entities, they have not disclosed the amount of fines, and where in this case, and where they have not disclosed the entities, they have disclosed the fines. Ministry of Economy and Tourism. This is inspection results and fines campaigns. 1,063 compliance violations, as Saqib has already highlighted. Themes cited were customer due diligence protocols, risk assessment methodologies, suspicious transaction reporting mechanisms, combines desk-based reviews with targeted financial inspections. And okay, the fines range, the 1,063 violations, the fines exceeding 42 million for precious metals and 20 million, more than 20 million for real estate sector. For corporate service providers, 18.5 million, auditors, 4 million plus. FIU has generally observed at a national level that the quality and quantity of information in the STRs and SARs reported to the FIU is inadequate. They need more information. Okay. So for banks, the enforcement for the CBUA, the overall penalties imposed are more than 370 million across banks, exchange houses, and insurers since last year, since 2025. And largest single AML fine imposed is of AED 200 million. So overall, from these findings, from the thematic reports and from the penalties imposed, we can say that the regulators are looking for a live and board-owned business risk assessment, actual version control document, not just a formality, and it has to be updated on an annual basis. And they are looking for assessed targeted financial sanctions, proliferation financing as distinct components, not covered within the money laundering risk, and make due diligence evidential that and obtain source of funds and source of wealth documents for high risk customers and senior management approval as well. And the trade-based money laundering report should be adequately reported and identified, and wash trades should also be adequately identified. So from here, I will hand over to Mr. Sakib.
Thanks, Harish. If you can go to the next slide, please. So I think we've kind of covered what the regulators' expectations are, FATF, and the regulations. What next, right? And when you look at this slide, I think this is probably one of the most important slides in our session. Is what to do next. In the past, you might have been able to respond to an inspection by providing a policy manual and some documentation. But things have changed. I mean, those who've been part of these inspections or who've been visited by a regulator, the first question the regulator asks you is, show me the evidence, right? You can have all the best policy and procedures in place and in terms of enterprise-wide risk assessments done, but they want to really see the evidence. And this is what I've seen when I'm working with clients on inspections. Is they would like to look at supporting documentation and then detailed review of how this is being implemented. The other thing is I often tell my clients, which surprises them, regulator does not expect perfection, right? So it's not as if you need to have perfect policy and procedures and all that. There are of course bound to be errors, oversights, or whatever, but I think fundamentals should be there. And one of the first questions generally these regulators ask is that they don't come and ask the MLRO. They're more interested in talking to the frontline staff. Do the frontline staff understand your AML CFT framework, right? Because they are the first line of defense. They need to understand. They are interacting with their customers, clients directly. So when these inspections happens, they would select on a sample basis and go and speak to the frontline staff. So when you look at this, I mean, most of you would say, yes, we are doing this anyway. But things have changed, as I think Nasir mentioned earlier about tax evasion. Sarish mentioned about digital currency. So your enterprise-wide risk assessment, whenever you've prepared it, needs to be updated to cater to those risks. You of course have your national risk assessment. You need to take account of whatever the UAE as a whole, when they look at AML risk, have you incorporated those in your enterprise-wide risk assessment? So I think that is absolutely critical. Now, if you've not updated your enterprise-wide risk assessment, we generally advise our clients to kind of do a refresh on an annual basis to see whether anything needs to be done. But if it is old, then of course that is very, very important that you address it. And then, of course, the next step is your KYC to CDD. And again, your response may be, we're doing that anyway. We're obtaining the Emirates ID, we're obtaining the passport, we understand what is required. But the question is not obtaining the document. The question is, you really need to understand who your customer is, who owns your customer, right? Obtaining Emirates ID, passport copy, it's fine. But generally what I've seen the regulator is more interested in is the source of funds and source of wealth. And I know when I discuss it with the clients, they're always saying, I can't go to my customer and ask for their bank statements or evidence because by doing that, customer would just walk away. Unfortunately, that is, as Ms. Sarish mentioned earlier, one of the key observations from the regulators, ADGM. You can Google it. This report is available publicly. One of the areas they said, when they did the inspections, the client did not obtain source of funds. They just based on verbal discussion, whatever the customer said, they documented it. Sometimes they didn't even document it. But even if you documented it, but they've not seen the evidence of it, right? So that is very, very important. So when we talk about KYC, I see companies failing because they have not looked at the source of fund. The other one is beneficial ownership, right? Most of the money laundering breaches happen because of beneficial ownership. So you can set up a company in free zone or whatever, but you really need to understand who owns this company, right? So anyone who owns more than 20-25%, you need to get that information, their passport copies and all that, right? Revisit governance framework. Yes, you have a governance framework, but I think the key change in 2025 regulation is who is responsible, right? Is it MLRO's responsibility? The answer is, if you look at the regulations in detail, the shift, the responsibility shift is moved from, again, MLRO is responsible, but it's moved to the board of directors, right? At the senior management. They need to take ownership of it. What the regulator does when they come and inspect it, they say, okay, MLRO on a regular basis, what have you reported to the board, right? Okay, if you report it to the board, that's fine, but is there any engagement discussion from the board on the report, or is just a tick box exercise that you've sent, biannual report to the board of directors, and when they look at the minutes of the meeting, there is absolutely no discussion. Again, that is an area where I've personally seen where the regulator has criticized that there should be active engagement from the board of directors in terms of what is really happening. Strengthening monitoring for digital virtual currencies. Now, you may not be dealing with crypto. You may not have a customer who's paying you in crypto, and you say this does not apply to me. Again, the question here is, do you really understand your customer? Is your customer earning through crypto, right? So you need to understand the nature of the business, and again, that carries high risk. That carries risk, right? Update policy and procedures. Again, if you've not done that in the recent past, I would certainly strongly suggest post 2025 regulations, you need to update your policy and procedures. And again, assign responsibilities, not just to the MLRO, but also to the board of directors in terms of what really needs to happen. And finally, expect, as Nasir mentioned, we got evaluation coming, and expect more intervention from the regulators, more inspections, sometimes snap inspections. So that could happen. And if you were to honestly ask yourself, what is if the regulator is to come knock on my door tomorrow? Am I ready for it, right? Because I have seen companies struggle and panic when you get that call from the regulator, or when you get your physical inspections, because they would come and they ask you, okay, they will ask for the standard documentation, training manual, they will ask for KYC documents, but again, they can go back 5 years, right? And then of course the panic sets in, and in terms of breaches or whatever, and that's why you've seen all sorts of penalties being imposed. So I will close this by just making final remark. The cost of compliance is visible on your budget, right? the cost of compliance appears in your tomorrow's headlines, right? And you've seen that in the recent past. So bear that in mind. Board of directors in particular need to see compliance as a strategic function and not a back office. And again, I have seen that, I mean, banks, of course, have got structured compliance function, all that. But what I'm seeing is designated, DNFBPs, exchange companies, I've seen more and more board taking a keen interest in terms of making sure that there are no penalties, because in this part of the world, yes, financial penalty is taken negatively, but reputational risk is much more important. And all the more reason, as if you're a head of compliance or you're in the compliance function, it is your responsibility to protect the interest of the company as well as the shareholders. So I'll just pause here and pass on the mic to Khushbu.
Thank you very much, Saqib. Thank you, Nasir and Serish. I believe that this session would be of utmost importance, highlighting most of the new changes that has come across. Maybe we can shift to the questions. We have few questions. I'll start taking them one by one, and I have some more questions I have come across. So we can ask from, and all the attendees, if you have any questions, please write in the Q&A box so we can take it directly from the speaker. Okay, so the first question I can see is from Nasir, from here, from your presentation. Nasir, Mr. Aziz Rehan is asking that which of these regulatory requirements are general, that every business should comply, and which one are specific to some sectors, example, financial, real estate, etc. So if you can just pen down some of them, I believe that they are more keen in asking what is applicable to real estate or what is applicable to financial. You're mute, please, Nasir.
Thank you, Khushbu. If you can just go to the slide that I have mentioned. Actually, we need to understand that the regulators are different for the financial sector and for the DNFBPs. So what I have covered the important regulations that have been issued by all the regulators. It includes the CBUE regulation, and I mentioned like this, that this regulation have been issued by the CBUE for the licensed financial institutions, and the regulations that have been issued by the DNFBPs regulators, I have mentioned it separately. And even I've mentioned about the real estate. If you go into the slide, I think not this one, go up. Yeah, this one. So if you see, I've written about the, okay, here I think it is not there, but I can just tell you that DNFBPs regulators have issued separate regulations, and CBUE have issued separate regulations, and I have covered in detail about those regulations. But if you need further details, I can always give you the reference of the regulations that have been issued by CBUE and that have been issued by the regulators of the DNFBPs. I have all the list and I will share with them.
Thank you very much, Nasir.
And the basic thing needs to be understand that the regulators are separate. So once the regulator issue the regulations, it is written very clearly that it is for the licensed financial institutions comes under CBUE, or it is the licensed financial institutions comes under the regulator of DNFBPs, or it is issued by the VARA for the VASPs or virtual asset service providers.
Thank you, Nasir. There's one more question, again related to your presentation. Okay. As we know that tax evasion is a predictive crime, but what about tax avoidance? If someone is avoiding the tax but not violating the regulatory requirements, does this will also be considered as a predicted crime since they are not violating any law? Very political question.
Interesting question. Actually, I think the laws and the regulations are very, very clear. These wordings, whatever you use, tax evasion, tax avoidance, blah, 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 you can use any terminology, but one needs to be careful. Now, I'm not talking about now as an individual. My concern is with the compliance officers sitting in the regulated entities. Once they are sitting in the regulated entities, they must, I'm using the word must, identify all such transactions where they have the suspicion of tax avoidance, tax evasion, whatever they can say, and they must file STR immediately. Once this STR goes to the FIU, then comes the law enforcement agencies. The FIU gathers the intelligence from all the banks, and then they make a report, intelligence report, to the concerned law enforcement agency. And then comes the law enforcement agencies, because now they understand that it is a criminal liability, it is a predicate offense of money laundering. So they will not only come for the tax evasion, now they will come with the offense of money laundering as well. So anyone who is doing tax avoidance or tax evasion, they should also be careful that it is no more only tax evasion. The money laundering criminal liability would also be there by the law enforcement agencies. Thank you.
Wonderful. I think both the questions have been answered.
Can I just maybe, Pushpa, just on the point which Nasir raised or responded, I just wanted to highlight one important part. Generally, tax avoidance is not generally not a predicate offense. As long as you're using lawful use of available exemptions, right? Tax evasion, definitely, because that's concealing income and that's where the regulation changed, because they mentioned tax evasion in particular. So as long as you're doing tax avoidance using lawful means, it's fine. No underlying crime means that there is normally no proceeds of crime to launder. I just wanted to highlight that to you. Yeah.
Thank you, sir.
Thank you. Just add on, Saqib is totally right. But as a regulated entity, once we are in the compliance, we must be careful of all such transactions and must file STR.
Yeah.
Wow, that's some good news. Okay, there's one more question I'd like to direct it to Serish. Serish, you have been in the industries and on the clients where you are dealing sometime as an MLRO yourself and maybe dealing with the MLROs and the DPOs. In organization where AML and data protection obligations overlap, could a DPO also be exposed to regulatory penalties, or would accountability primarily rest with, okay, so basically they're asking, will these penalties or compliance requirement is limited to the MLRO, or the DPO will also come in place if there is any non-compliance? So are they overlapping, or how do you segregate both requirements?
So thank you, Khushbu, for the question. Basically what happens is there are two different regimes. One is the AML regime and the other is the PDPL regime. There's an AML law and there's a PDPL law within UAE. So they don't really overlap. If the DPO is involved in some type of non-compliance related to the PDPL law, then they will be fined. However, they will not be imposed any penalties on the basis of non-compliance under the AML laws, unless they are also the registered or designated MLRO. So in that case, if they are engaged in the AML compliance, if they are vested with a responsibility, they might be held responsible. However, just because they are DPO and responsibilities are overlapping, they don't have any accountability, I would say.
Just to add to what Sari said, so I think the more accurate position is accountability, whether it's DPO or whether it's MLRO, it's role specific and maybe concurrent, right? So MLRO cannot transfer responsibility for AML compliance to DPO, understandably, and DPO cannot rely on the AML function where the organization's handling of personal data breaches applicable, privacy requirements. So the organization and senior manager, again, overarching, responsible for PDPL laws as well as AML laws. Okay.
Yes, and let me add on that senior management, like Saqib has said, and board members now actually responsible for AML law and data protection both. So if MLRO needs any data, DPO has to provide those data to the AML, but both have to coordinate about the data protection as well as the data needed for the filing of STR. Thank you.
Okay, Nasir, I think in connection to the previous question regarding tax evasion, someone is asking that what about the money laundering punishment without predicating offense?
Actually, wherever I go for the training, because I have the background of law enforcement agencies, plus banks, plus central bank. So I always tell people that normally what we are doing in the regulated entities, that if we have multiple scenarios. They see the alerts come up. With the alerts, we make the cases, and from the cases, we investigate further and file the STR. Normally, I've seen that people do not have an understanding of the predicate offense. Whenever we are filing STR, I always tell my teams when I was MLRO in Pakistan, and even here as a regulator, that please keep in mind that what predicate offense you are thinking once filing STR. Yes, there are few cases where you cannot have a clear picture, but in most of the cases, my experience says that as a MLRO or as an investigator in the compliance function, we must understand that once I am filing a STR, what is the predicate offense? Because that predicate offense helps FIU to make the intelligence report and send that intelligence report to the concerning law enforcement agencies. Without the predicate offense, no one would be clear. So all this exercise which is being done for filing STR, then going into FIU, then FIU making intelligence reports, sending into law enforcement agencies, is actually identifying the predicate offense behind this money laundering.
Understood. Thank you, Nasir. Okay, this is a very interesting question. So, are there any specific industries you believe will receive increased regulatory scrutiny over the next few years, or is it equally strict for all industries? Maybe I can answer that very simply, that law is a law. It has to be implemented at any cost. Avoidance of law is not an excuse. Yeah, it depends which industry is in the trend. They will pick up and they will try to improvise it. But I think it is applicable on all the industries. Maybe our experts can shed some more light. Sarish, you wanted to say something?
Yes, thank you, Kushbu. So basically what happens is risk assessment is conducted on a national level, sector-wise. And on the basis of that, input is fed, obviously, to FIU and the law enforcement agencies. So the probability of getting more inspections is for the sectors which have a higher risk. And obviously the risk assessment is done. It's a loop. The inspections were conducted, the results were fed into the system, and then STRs, SARs on the basis of the results of that risk assessment is done. And on the basis of the risk assessment, further plans are made for continuing inspections. So the sectors, specific sectors which are identified as high risk have a higher probability of getting an inspection. But obviously, everyone is at a risk. I wouldn't say at a risk, but everyone has a fair chance of getting inspection.
Let me
So
just
we
add
shouldn't.
on. Sorry. So please continue. I thought you have finished.
So being audit firms, if we are low risk, we shouldn't expect that the regulators would never come to us. They might as well come tomorrow. So there's a fair chance. Everyone has a fair chance. Yes, Nasir, sorry.
Yes, please. And because I have an experience of dealing with the FATF team and being the regulator, I can tell now FATF has more focus on the DNFBPs and the crypto sites. The way Sarich has said, the high risk sector. If you go and see all the jurisdictions, not only UAE, normally the licensed financial institutions are more compliant with the AML CFT requirements than in comparison to the DNFBs like real estate, like lawyers, notaries. So everywhere, because I've read the mutual evaluation report of more than 24 of the country. So DNFBPs is always identified as one of the high risk and the weak sector. And now the crypto is coming. So these are the two sectors, I think, which should get more focus from the regulators in UAE and might get more focus by the FATF assessors in the fifth round of mutual evaluation. Thank you.
Thank you. I have one question. I would request Saqib to take it as an. So usually at my clients, what I see, the MLRO is extremely talented. They know everything. But as you said, that the frontline workers, they lack most of the important information. They are told to take KYC information, which is limited to maybe Emirates ID or trade license. So how do you, or maybe what do you suggest to make sure that the first level of screening is as strong that you don't have to go to a very extreme screening levels? So what do you recommend? What you are recommending your clients, that how they make sure that everything is filtered out at the first level?
Yeah, so thank you. So I think the general concept is, you got the first line of defense and then you got the third line of defense, internal audit. The company has internally established internal audit department, and of course that there should be regular reviews of how the frontline staff is handling potential customers. If they don't have the capability, then of course they can outsource it to external consultants to help them conduct health check reviews. And again, this is I've experienced this in the recent past where the regulator did specifically ask for independent reviews of the AML function. And that was the second question from them in terms of when was the last time an independent review was conducted. Because that again gives the regulator comfort that their policies are being followed, whatever is documented is being followed. And what I think is extremely important is training, right? So regular training, whether it's going to be biannual or an annual, especially I've seen issues where you got staff joining midway through the year. You already conducted at the beginning of the year. What do you do with that? Because he's again a frontline staff. There should be a mechanism of training that person in terms of what needs to be followed. And again, I've seen cracks there where a person joined in March, and the next training is going to be in December. So those 6, 7, 8 months, he was just given some verbal instruction in terms of what needs to be done. And unfortunately, then he was unable to follow the instructions. And then there were some breaches or oversights in that part. So if you were to ask me, 2 layers, one is training of staff. And the second is independent reviews or reviews by your internal audit function. Only if they have the understanding of the AML compliance framework. I think that's very important.
Yes, Sarish.
So here I would like to add the recent requirement of the law is that whenever like what Saqib has already described, whenever there's a new induction, there has to be a training of those staff within 30 days of their induction. And they should be, yes, this is a new requirement and this should be complied with. This is for the information of everyone.
Wonderful.
Okay, just one more thing. The way Saqib has said about the training, my training experience tells me that because the first line of defense is more oriented towards the business, they are business oriented, they are looking for the more and more business. So in some frequency, we must train them about the AML, CFT repercussions, and now the examples of the personal accountability, so that they should strike a balance between the business and the compliance requirements or the AML, CFT requirements. Thank you.
So I would like to add one more point here. That is exactly why the compliance, the MLRO does not report to the commercial, the head of business, because the commercial interest will always conflict with the compliance requirements. Thank you.
That's very important point that you made, Sarish. Okay, one more question. It's about personal liability of the MLRO. So with this liability or maybe commitment, what do you guys think that, because MLRO is an employee, and as per your experience, how they are catering up to this new requirement, and where is the line that segregates an MLRO from not being penalized for something that they have not done, and like as an individual, I would like to know, and I'm sure most of the people who are attending this session, if they are an MLRO, they would like to know how they adapt this new requirement and how they make sure that they are not personally responsible for something they have not done themselves, or maybe how they ensure that nothing comes on them as an individual. Yes, Arish.
So this is a very interesting question, and I've been thinking about it. What happens is, obviously, MLRO cannot have all ears and eyes everywhere, right? Whatever business function goes on. But what the MLRO can do to secure themselves is maintain a proper audit trail. If something comes to the notice, they have raised an STR within 24 hours. They have ensured all types of compliances. And whenever personal penalties are raised, they're not because of one-time non-compliance. They are recurring matters of non-compliance. The enforcement agencies have notified the MLROs and the organization about taking actions. But like, if the MLRO can demonstrate that they have fulfilled their responsibility. Like, for example, there's a brokerage case and there was wash trades cases, right? So they have clearly, the enforcement agencies have clearly marked that this is not because they were involved in money laundering. They were not. They failed to file an STR on a timely basis when they noticed this. Obviously, they did notice. So this is what the MLRO should secure themselves. And for all the organizations, the MLROs should be qualified, and the MLRO should have adequate experience.
And just let me add on, Sarish has elaborately covered. Uh, Being MLRO in two of the major bank in Pakistan, I can tell my experience that MLRO is a big responsibility. And normally, whenever myself and my team had the suspicion of any money laundering in the transactions, we always used to immediately file STR or SARs. We never used to wait. Even we used to work late at night, but we used to file STR immediately. And there was no influence of any commercial side, any business side, or any top tier. I was the decision maker. So once I decided the SCR has to be filed, and then we used to keep it very, very confidential because we were aware of the fact of the tipping off. So once we used to file STRs, it used to be in very, very close circle of my team, the team who has investigated, and myself. If there is a separate team, they are coming with a separate STR, they would not be knowing that another team has filed the STR. So confidentiality, the responsibility with the MLRO, and the freedom to file STR with the MLRO is very important. And that makes you safe from such type of personal accountability. And the way Sarish has said, it is not because I'm a regulator here as well and understand that it is not once, it is recurring. Once regulator or the inspector goes and find that these are recurring instances where they have done such things, then they go for the personal accountability of MLRO. Thank you.
Great. Thank you very much, speakers, and thank you very much, attendees. I think we have extended our session with almost 18 minutes more, but I think it was a wonderful session, and thank you for sharing your practical insights. The team will send out the presentation to all attendees, inshallah. And the last point that I would like to make is compliance is not something that you can think of. It is mandatory. You have to adapt it. You have to give your MLRO space and independence to make sure that the compliance, that they follow the compliance, like Nasser mentioned, that they have to be the ultimate decision maker, just to make sure that there are no fines or penalties imposed at a later end of when there are any inspections or anything. So make sure you do all that is required by the law, and maybe you can share your experiences, what you have been through with us on our LinkedIn pages, on our personal profiles. You know, it's me, it's Khushbu, it's Erish, Nasser, and Saqib. You can reach out to us on LinkedIn, and maybe you can reach out to us on the mentioned email ID. Thank you very much. Have a nice day. Allah Hafiz.
Thank you.
Thank you.
Thank you.